Hello, everyone, and welcome back to another episode. My name is Jordan. I'm the Millennial Investor. And if you haven't seen my channel before, what we do is we invest in two types of portfolios. The first one is dividend growth portfolio. We invest in very defensive, safe, cash flow companies that are going to grow their dividend payments over time, and hopefully that'll provide lots of risk-adjusted opportunities for investing in the stock market. And then the other one is the growth portfolio, where it's very offensive and we attack very heavily in the stock market. It has extreme volatility and lots of opportunity for growth. And today we're jumping in the dividend growth portfolio. And tied for the largest position, we have three at 9% target weightings, which is W.P. Carey, Lockheed Martin, and JP Chase. Now, right now, JP Morgan is tied for the largest position in the portfolio, and we're going to go over in this video why. Now, right now, the reason why it's one of the largest positions of the portfolio is not because I think it's going to be a great investment over the next several years, but I think it has lots of opportunity to defend your capital against this recession that is coming up. So we're going to go over in this video why I think it's great, why I think I'll potentially be buffing it up in this portfolio. If you haven't checked M1 Finance out before, I've had 124 people sign up so far. You can get up to $10 for getting signed up right now, and sometimes I even raise that higher, as high as $50. And if you want bigger bonuses like that, we have up to $100 for getting signed up with credit cards, or if you want to speak with me directly for a mentoring session, this is where you go to do that. But other than that, thank you guys so much for tuning in. This is my performance year to date, as well as other statistics as well, if you're interested in that. But let's go ahead and get started and jump straight into the portfolio and looking at our 21 slices right here. These are the 21 companies that we own, all in different sectors, all different types of companies, all different businesses, different valuations, different market caps. But one of the ones that's the largest in the portfolio is JP Morgan. Now, why is that? The reason why JP Morgan right now is one of the largest in the portfolio is for a couple reasons. The first one is, to be blunt, the stock price has been in the garbage. It's went nowhere. It has went straight down for the last year or so. In the last year, the performance has went down negative 25.71%. Year to date, it's negative 29.14%. This company is down roughly 30% from its all-time highs, while I believe the company has done a great job of maintaining its capital well and providing ample returns for shareholders. If you look at the JP Morgan chart here on Qualterm Insights, you can see that the revenue charts are looking stellar for this company. You have a stock price, like we showed right here, that is going down and down and down, right? But what is its revenue doing? It's going up and up and up. What about its profits? Is its profits holding up fine? Yes, they are. If you look at its net income, not quite near the record levels that we had earlier in 2021, but still very high. Last quarter producing about $8.5 billion worth of profit, doing just fine. The dividend is doing just fine as well, also coming in at about $1 per share. I'm not sure if they're going to raise it this year. I don't think they are because of the conservative nature of being in a recession. But that said, regardless, I think that this dividend will be raised a lot over the next 1, 2, 3, 4 years. Right now, if you take the dividend, which is $1 every quarter, multiply it times 4, you take $4, divide by today's share price of $114, you're looking at right at a 3.5% dividend yield. So regardless of whether or not the stock price goes up, you're going to make 3.5% on your money just to sit and hold, okay? Now, here's what's interesting about this company. It is not like any other bank. I think that this company is much more innovative than many other competitors like it, compared to a Bank of America or compared to a Citibank or anything of the sort. And I think that this little first paragraph of this Seeking Alpha article puts it perfectly. Sometimes these Seeking Alpha articles aren't that good. Some are really low quality, but I think that this one does it perfectly summed up in just 2 or 3 sentences. I prefer the best over the cheapest. While the best doesn't always come out at a reasonable price, in rare occasions, the patient investors can accumulate shares of an industry leader at depressed prices. Then it pays to be aggressive. Looking at JP Chase risk-reward ratio, I argue the industry leader in banking is currently on sale. And I think that is a perfect way to summarize it. I think that this company is higher quality than most other banks out there. And what is my reasoning for believing that? Well, I think that in many different scenarios, we can give examples where this company is outpacing its older big brothers, like a Bank of America, like a Wells Fargo, Citibank, whatever. If we pull up Yahoo Finance here and we take a look at its valuation, one of the main ways that people tend to value banks, especially big banks, are price to book ratio. If we go to statistics here and we look at the last several quarters, in June 30th, 2021, the price to book for JP Morgan was 1.8. And then a quarter later, it was 1.9, 1.8 again. It went down March to 1.5 and then to 1.3. And then today we're at a 1.3 book to price ratio, price to book ratio. That is significantly low for JP Morgan. And that's below its historical norm. Now, furthermore, like I said, what is my reason for believing that it is a better quality bank compared to its competitors? Well, in 2021, CEO Jamie Dimon, which by the way, in case you didn't know, he's one of the most well-respected CEOs, has an incredible track record, and has been with JP Morgan for a long, long time. So go ahead and look him up if you want to look more into him. But long story short, in 2021, he said that, quote, the firm would spend whatever it takes to beat the competition, adding that companies expand beyond just BNPL into other offerings like debit cards. They become even more of a threat. This year, Diamond has come up against criticisms for investors from the bank's rising expenses, but he shows no signs of backing down from his quest to remake the company at a time when more people are turning to their phones to cash checks, pay debts, or invest. On May 23rd, the bank held its first ever investor day in 2 years with eyes towards selling investors on its tech vision, including costs. JP Morgan said spending on tech alone will total $14.1 billion in 2022. $14.1 billion, that's an incredible number just on its tech division. Nearly half of that, or $6.7 billion, the bank's CIO Lori Beer said that in a presentation it will be spent on, quote, on change the bank investments. Now, this is the type of opportunities that I'm talking about with JP Morgan. They're not stuck in the old times, and they're relying on the boomers to fund their profits, to fund all their reinvestments back into themselves, and funding lending to other investors, to other consumers, so that way they can grow their bank. They're looking on reinvesting back into themselves on future, quote, change the bank investments. And this headline right here, which was a big one back in the day, is a perfect example. JP Morgan Chase takes on Square and PayPal with smartphone card reader, faster deposits for merchants. And they give opportunities for benefits for small businesses since they have such leverage with their size and scale. They can do things like this that other smaller competitors, such as like a PayPal and especially one like a Square, normally can't, or they'll struggle to do so. So looking at this, when you look at this company, you see that it is a fantastic company. It's very defensive. Now, what is the reason why it's so defensive? Well, as we've seen, when this company went down in price, you see that the stock market was propped up by the Fed. When the Fed pumps out money, who receives a lot of that money? JP Morgan Chase. And speaking of the Fed, I wanted to give my last point here, which is the federal funds rate. If you're not familiar, ever since the 2008-2009 Great Recession, the government changed the way that banks are regulated and forced them to hold billions and billions of dollars on hand, right? That's why if we look at their cash to debt here and we take away the debt and we just look at the cash, you can see that the amount of cash that this company holds is massive. Right now, as of the most recent quarter, they have $891 billion on hand. Now, that's not just JP Morgan, that's also customer deposits, but just last quarter they had over $1 trillion. That's right, with a T. Over $1 trillion of money on the books. That's incredible, right? So when you see this federal funds rate, the amount of money that they can receive just for having that money sit there, right? The risk-free return, normally over the last year or two, the last 2.5 years, it's been at 0% right here, right? Well, now they're earning 2+% for that money that's just sitting there, as well as their other loans. Now that instead of getting a house loan, instead of selling that for 3%, they can sell that for 5%, 6%. So instead of having a car loan for 7%, maybe they're selling that for 9% now. So the interest income that JP Morgan's about to receive, I think, is about to go through the roof, and I don't think that's going to stop all throughout 2022 and likely throughout most of 2023. So I think we're going to see record revenue numbers very soon for the company like JP Morgan, and I think that its earnings per share and its net income is likely going to follow suit. Regardless though, even if I'm wrong, pretend that everything I said was wrong. You're looking at a company that's trading at a historically low valuation, a considerable dividend yield of 3.5%, and one of the largest, most defensive companies in the world that is propped up by the Fed. To be honest, do you ever see a vision? Do you ever imagine a scenario where the United States government lets JP Morgan Chase fail? Because I don't. Now, first off, this company is well capitalized and would never go bankrupt anytime soon. Not in 2022, not in 2023, maybe 100 years from now, but not anytime soon. But even if they did get in trouble, if this company started taking on massive loan losses and started to lose billions of dollars, do you really think that a company like this would ever be allowed to go bankrupt under the United States government's umbrella? Because I don't. There's many companies that would be allowed to go bankrupt, 99.99% of them, but this is probably one of the few exceptions. You saw how much work was done to keep banks and many other companies like this propped up during the 2020 crash. If we ever did have a major economic downturn, what are the odds that JP Morgan Chase ever really goes bankrupt with the new standards that we have in place? So that's why I have JP Morgan the largest position in the portfolio, tied for one of the largest, and I think that likely don't be surprised if over the next couple weeks, couple months, if I even make this larger into the number one position, having it at 10, 11, 12%, anything like that. But regardless, guys, thank you for watching all the way to the end. If you want to get signed up with anything down below, like credit card referrals, M1 Finance sign up, or mentoring calls with me, go ahead and check that stuff out down below. Thank you for watching all the way to the end, and I'll catch you guys next time.